Hey everyone, welcome back to Corporate Decoder. Today, Scale 1 Incorporated NCO just filed an 8K reporting the closing of its initial public offering, and I am seeing a significant move that hints at their operating strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just completed its IPO raising over $100 million, and this filing details how they put that money to work and who the key players are now. So, on the 20th of July 2026, Southern Cross Acquisition I Corp, or NCO as it is traded, successfully completed its big public debut. This report, filed just a few days later on the 23rd of July, is essentially a confirmation of that event and lays out the details. It is the official paperwork that says, hey, we sold our shares, and here is what happened. This is a special type of company called a SPAC, which stands for Special Purpose Acquisition Company. Basically, these companies are formed to raise money through an IPO with the sole purpose of finding and merging with another existing private company to take it public. So, North Carolina O is now officially a publicly traded entity, and the hunt for a merger partner is on. The company's units, which are a package of shares, warrants, and rights, are now trading on the Nasdaq. This is a major milestone for any company going public, marking their entry into the main stock market. Let's break down what people bought. They sold what are called units, and each unit is actually made up of three things. One ordinary share, which is a basic piece of ownership. One redeemable warrant, which gives the holder the right to buy more shares later at a set price. And one right, which can be exchanged for a fraction of an ordinary share. This structure is common for SPACs, aiming to give investors multiple ways to benefit if the company does well. Now, the company is checking the box to be considered an emerging growth company. This means they get to take advantage of some regulatory flexibilities, which is pretty standard for new public companies. They've also elected not to use the extended transition period for new accounting standards, so they'll be adopting them pretty quickly. This section talks about the actual nuts and bolts of the IPO. On the 20th of July, their registration statement, which is like their prospectus filed with the SEC, was declared effective. Then, on the 22nd of July, they closed the IPO, selling 11.5 million units. That is a big number. And it included the underwriters taking an extra 1.5 million units to cover any oversubscriptions, meaning there was a lot of demand. And the result of selling those units, a massive $115 million in gross proceeds. That is the money they raised before any fees or expenses. A significant chunk of change to start their quest for a merger. But it wasn't just the public investors who bought in. The company also sold private units to their sponsor, Southern Cross Acquisition I Corp. That is essentially the group that got this whole SPAC operation going. They bought another 239,300 units, bringing in an additional $2.39 million. These private units are pretty much the same as the public ones, but with some restrictions, which is also pretty standard for SPAC sponsors, and who helped them sell all these shares. The underwriters, represented by D. Borrell Capital LLC. As compensation for their work, the company issued 115,000 ordinary shares directly to them. These are called representative shares, and they come with restrictions on when they can be sold. Typically for a period of months after the IPO to prevent immediate dumping of stock. The underwriters also agreed to waive certain rights, like getting money back if the company doesn't find a merger, and promised to vote in favor of any proposed merger. This shows their commitment and alignment with the company's future. This section just lists out all the main agreements that were put in place for the IPO. Think of it as the legal contracts that make everything official. We've got the underwriting agreement, the warrant agreement, the rights agreement, and several other subscription and indemnity agreements. These documents govern how the shares were sold, how the warrants and rights will function, and the responsibilities of everyone involved. This part reiterates the private sale of those 239,300 units to the sponsor. It confirms that these weren't sold on the public market through a registered offering, but rather through a private placement, relying on an exemption from registration rules. The key takeaway here is that the sponsor is financially tied to the IPO's success and is bought into the company's prospect. This is important because it tells us who is now in charge. Effective the 21st of July, 3 new directors joined the board: Jiqiang Du, Joy Liang, and Chen Xu. The company states that these individuals are independent, which is crucial for meeting stock exchange rules and for good corporate governance. It is also noted that Jiqiang Du is considered an audit committee financial expert, meaning they have financial smarts and can oversee the company's financial reporting and controls. Du will chair the Audit Committee and Zhuo Liang will chair the Compensation Committee. This signals that key committees are now formed with qualified individuals. A good sign for oversight. Interestingly, before the IPO officially closed, the sponsor transferred some ordinary shares to the new key officers and directors. Ally Tongjiang, the CEO, got 5,000 shares, Su Wai Lam, the CFO, got 3,000 shares, and the 3 independent directors each received 2,000 shares. These transfers happened at a very low price, essentially pennies per S-hair. This is a way to align the incentives of leadership and the board with the company's performance from the very beginning. They are also being reimbursed for expenses related to finding a merger target. On the 16th of July, the company also updated its governing documents, its amended and restated memorandum and articles of association. This is like tweaking the company's constitution to align with its new status as a public entity and to reflect the terms of the IPO. This section clarifies where all that IPO money is going. A total of $115 million from the IPO proceeds and private unit sales has been placed in the company's trust account. This account is crucial for SPACs. The money in the trust account is generally held aside and can only be used for specific purposes, primarily to complete the company's initial business combination or to be returned to shareholders if a merger isn't found within a certain time frame. This is where they announce the initial pricing of their shares. It is common for companies to announce pricing before the actual closing of the IPO. And here is the announcement that the IPO actually closed. These press releases are essentially public relations tools to inform investors and the market about these significant corporate events. This exhibit is the main contract for the IPO, outlining the terms between Southern Cross Acquisition I Corp and the underwriters who helped them sell the shares. This is the agreement detailing the terms of the warrants that were issued as part of the units. It specifies how they can be exercised and their expiration. Similarly, this agreement lays out the specifics of the rights that were also part of the unit offering. This is the press release that announced the pricing of the IPO. And this exhibit is the press release confirming the successful closing of the IPO. And to wrap it all up, we have the signature of the Chief Executive Officer, Ally Tongjiang, confirming the accuracy of this report on behalf of Southern Cross Acquisition I Corp. This signature signifies the company's official filing of this important information with the Securities and Exchange Commission. So, what does all this mean for Southern Cross Acquisition I Corp? They've successfully raised over $117 million, with the majority coming from the public and a good chunk from their sponsor. They've put this money into a trust account, ready for their primary mission, finding a private company to merge with and bring public. Key leadership is now in place, and the company is operating under the full glare of the public market. The big question now is what company they will merge with. SPACs have a ticking clock, usually around 18 to 24 months, to find a target. If they don't, the money usually goes back to the shareholders. The fact that they've formed independent committees and have an audit committee financial expert signals a commitment to good governance, which is positive. However, the history of SPAC shows that many struggle to find the right merger partner or deliver value post-merger. The key here will be the quality of the target company they eventually acquire. A well-chosen merger can be fantastic, but a rushed or ill-fitting deal can lead to significant value destruction for shareholders, a pattern we've seen with other SPACs in the past. Alright, that is our breakdown of Southern Cross Acquisition, I Corp's IPO filing. What is your take on these numbers and what they signal for the company's future search for a merger? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you enjoyed this analysis, please like, comment, subscribe, and join our Discord community linked in the description.